Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Russell 2000 index, ticker symbol RUT. And before I get into this, let me just say that this is the first time in many years where none of the signals, and I mean none across the board in any market, worked out the way we thought it would. Now that's not necessarily a bad thing, because if you were long the market and we had sell signals along the way like we did last week, then your strategy would have been to trail the stop up. Now with that said, let me also add that the Russell 2000 is right at a key resistance area. You can see right here, I'm going to mark it with this timeline right there. That particular high on that day back in July of last year is going to be matched against this high right here and then projected out. So let me just draw that out for you so you can see how I'm drawing what's called a horizontal flat line. We're going to draw from that high out to this high, projecting out, and you can see that we are right at the key resistance point that I mentioned, and the stochastics down here is starting to hinge lower. The CCI, which is the commodity channel index, is hinging lower. And as I zoom in here, you'll see this is inverted hammer. Yesterday we had a doji. Now, what does that mean for next week? Let me just also add here that there is a wide divergence, a price divergence from this 20-period moving average. And that means the rubber band is getting stretched, just like that. And then if you notice back in the past, the stock does not like to stay that far above or below that moving average. So we are expecting a snapback. So let me erase all these lines and draw a clear line of what we think is going to happen for next week. I think the markets are going to pull right back to this level, and it might take a week and a half, maybe even 2 weeks. I'm going to go out 2 weeks here. And I think that the Russell 2000 could pull back to this support level, which will now be a role reversal support. This form of resistance, once broken, turns into support. If you want to learn more about role reversal, support, and resistance, just go to the Market Guys website. We have videos there that'll explain more about that. Now, if we look at the SPY, you'll see a similar picture. The spiders, the S&P 500 index, is at a resistance point right here from the highs back in July of last year. And so I'll project that out to the right. And again, as I zoom in, you'll see that we stopped to the penny right at that high. And this is a bearish engulfing pattern. So I think the S&P is also going to pull back just like that. I'll erase this line because all we're doing really is moving that on over to the right. And you can see that the stochastics right here is just about to cross with a sell signal. The K line, which is the blue line, once it crosses below the signal line, or the D line there, the red, that's going to generate the sell signal. And today the CCI crossed below the 100 level, and that generates a sell signal. So again, I think that the general markets, particularly the Russell 2000 and the S&P 500, are going to go down because the diamonds basically are 30 stocks. That's the Dow Jones Industrial Average, and the Qs are the tech sector. So let's go to the diamonds. I found something else that was very interesting. Not only are we at a resistance point from the highs back here in July of last year. Again, there's a horizontal flatline resistance, but you can see that the stochastics is also starting to cross. The CCI is ready to cross. We have a gap below the market here that I believe will ultimately fill. So let me erase that, and I'll move these lines over to the right. A gap is opened below the market, and that means there's an 80% chance that the market will pull back to fill that gap. So I'm going to leave this line here as a support level, and this is my projection line. Now if we look at the Qs, QQQ, that's the tech sector, same story all over again, with one exception. If you look at this high right here from yesterday, you'll notice that the CCI is matching the former high from back here. So I'm going to draw a horizontal line, again showing the highs of the CCI, and you'll notice that every time the CCI has gotten to that high level, as we see back here, the market's pulled back. So that's going to be very interesting to watch next week, because next week, as the markets open up in the beginning of the week, Monday and Tuesday, I think we can see a continued pressure on the sell side. This horizontal line down here is going to be my ultimate support level, so I'm going to erase this, move it on over to the right. That's going to be our gap fill support level, and then we'll see whether or not the market bounces from that point. But I think it could very well bounce, because at that particular price level, the 20-period moving average, which is this blue line, is going to more or less match up with that support level. So I think, again, the Qs could pull back. Now, if we look at the VIX, that's the volatility index right there, you can see that we have a long stretch of red candles, and we did not rally one bit on the VIX, and there's a gap above the market. Now let me just talk a little bit about gaps and the VIX. 100% of the time that we've been recording the VIX now, you have a gap that's open. 100% of the time, gaps have filled. So I've in the past staked my reputation on gaps filling for the VIX. So I'm going to leave that just like that, and I'm going to draw a 2-week projection line right up until that gap fill point. And remember, the VIX is inversely related to the S&P, so a bullish VIX is going to be bearish for the S&P. Well, keep an eye on the VIX right there. So we looked at the Russell 2000, the diamonds, the spiders, the Qs, and now the VIX. And I think that if you're following the market, guys, you'll know how to use what's called the 1% rule for managing risk. If you want to learn how to do that, just go to the Market Guys website, click on videos, and that will bring you to our video library. If you scroll down, you will quickly find the 1% rule right here. Just click on that, and it will bring you to a very short video. It's about 7 minutes long. That is, in my opinion, the most important video on this whole page, because it shows you how to limit your losses when the market moves against you. Not if the market moves against you, but when the market moves against you. And that's the whole key for success, learning how to lose very little when the market tries to take your money. So have a great weekend, and we'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.